Hey everyone, and thanks for joining me today. My name is Matt, and what I want to talk to you today about is the differences and similarities between ETFs and mutual funds. I remember a while back there used to be a phrase floating around where everybody would say, "Oh, same difference." And I never liked that phrase because I would always say, "Well, is it the same or is it different?" You can't be the same and different. But then I learned about ETFs and mutual funds and realized that that's actually a thing where something can be so similar but so different at the same time. So today, let's go ahead and just distinguish the differences that they have and also talk about the similarities so you can make better decisions when it comes to your investing. So to start, we'll just talk about how they're similar. So the first way that they're similar is that they're both broadly diversified funds. So they're both invested in large pools of either stocks, bonds, they could even be funds of funds, which is like a mutual fund holding on to other mutual funds. They could be invested in precious metals. So really what they could be invested in is almost infinite. They have so many different options there, and it's a great way to have one investment in your portfolio, but still be broadly diversified. The other way that they're similar is they both have expense ratios. Simply put, all an expense ratio is it's the cost of owning the position. So you don't even necessarily see these expenses, especially if you are invested in a low cost investment, but it's basically just what the companies that created these funds charge to pay their employees, keep the lights on, pay for their technology, all that good stuff. So something to bear in mind when you're looking at both of these investments is how much is it going to cost you to own that position. When I look at both of these, I like to see expense ratios for really both of them. I never want them to be over 1%, but honestly, I'm looking for funds that have even lower than a 1% expense ratio. Another way that they're similar to is that they can both be either actively managed or passively managed. Now, it is more common for ETFs to be a passively managed investment, but we do see some actively managed. And just to explain what that is, so an actively managed fund is something like a target date fund, which if you've seen my video, you know that that is my favorite investment. But basically what that means is there's somebody that actually is, I guess you can almost say, behind the scenes with these investments that is making adjustments to the portfolio based on the goal that they have, whether that be a target date fund, so transitioning it to a more conservative fund as time goes on, whether it's just a growth stock and if companies start to phase out of that growth, they might replace it with a newer company that's looking for growth. So actively managed just basically means that somebody's making adjustments to the way that's invested, as opposed to a passively managed fund, which is basically an index fund or something used to track an index. So if you buy like the 500 index fund, basically all that is it's tracking the S&P 500 and it's mirroring the market. So those see very minimal adjustments to them. You will see adjustments made to them, but it's not as frequently as an actively managed fund. Probably isn't even adjusted once a year. It might even be less frequent than once a year. It could even be like every 5 years or something along those lines. So again, actively managed, somebody's making adjustments to it fairly frequently, not all the time, versus a passive where it just tracks an index. Now, the thought process behind an actively managed fund is that, the advisor is either going to help you reach towards a goal, or the fund manager is going to help you reach towards a goal and become more conservative as time goes on, if that's what you're looking for. Or you can be looking for somebody who feels they have the right strategies in place to outpace the market. And that's a pretty big tongue twister. Outpace the play. Never mind, I forgot what I even said right there. So probably one of the last ways that they're similar, and this is where people start to get really confused, is a lot of times you can buy an ETF equivalent of a mutual fund. So they'll have basically the same investment. You're just deciding if you want to have the mutual fund of this investment or the ETF of this investment. So that'll bring us to how they're different. And this is what will help you make the decision as to what's going to be the best option available for you. So probably the most notable differences between an ETF and a mutual fund is the way that they're traded. So an ETF trades exactly like a stock. The price changes and fluctuates throughout the day. You can place your purchase and sell throughout the day, where a mutual fund is only priced once per day. And generally that's at 4:15 Eastern time, so after the market has closed for the day. And basically, again, what that means is if you wanted to buy a mutual fund, you see that its share price right now is like $13, so you think that's a good price to buy in at. You place your order to purchase that mutual fund. Well, at the end of the day, it can close up or down, and you don't know what price you're going to get it at. So it's a little bit of a risk there, but ultimately these are for the long-term investors. So the difference between $11 and $12, $11, $12, $14 a share over the long haul isn't going to make that much of a difference for you. And mutual funds are pretty restrictive when it comes to frequent trading. So it's not something that even like a day trader could get because you'll have an open order overnight. So that's one of the biggest differences is just, again, an ETF trades like a stock. So it changes up and down throughout the day, where a mutual fund is priced just once per day at generally 4:15 Eastern time when the market has closed. Another way too, though, is that they're different, is generally we see that ETFs are more tax efficient than mutual funds. Reason being is because when you buy an ETF, think of it like you're buying just your own portion of this. So it's just your portion of this fund, you own and control it. Where in a mutual fund, you're buying into the pool of investments with other investors. So think of like the episode of The Office where Michael Scott tries to pitch Andy and Jim on joining Jan's candle thing. With their $10,000, they're all joining that investment together in one business. So if one investor sells out of a mutual fund, there is going to be selling of positions that occurs at the fund level, and that means everybody in that position is taxed on that. So regardless of who buys and sells at any time with a mutual fund, there is the chance that all of the investors owning onto that position will be taxed. And if you want to know the tax rates, all that good stuff, as always, I just suggest speaking to an accountant. They'll be the ones to give you the best information as to how those taxes might affect you. That also, though, goes with saying that if you hold a mutual fund in a tax advantage account, so like an IRA, then you don't have to worry about the tax efficiency there because they're already a tax efficient account. We don't have to worry about paying capital gains or writing off capital losses. So bear that in mind as well. That's why a lot of times you'll see, not the only reason, but commonly why you see a lot of mutual funds in retirement accounts and ETFs in a non-retirement or non-tax advantaged account. Another thing worth mentioning, though, about mutual funds is that they might carry what we call load fees, or you might have heard a 12B1 fee, and they could be front-loaded, back-loaded. If you're going to purchase a mutual fund, it's definitely something worth acknowledging. For sake of this video, it's not completely worth getting into, but essentially all those load fees is it could be like an additional fee to purchase into this investment or to get out of the investment. So it's something very important to keep in mind if you're going to buy a mutual fund that has one of these fees, is to see how much that's going to cost you. Not all of them have these fees, but some do. And if you come across one that has these fees, just bear in mind how much it's going to cost for you to exit that position or get into it, because sometimes these can be a pretty substantial cost and it can really eat away at any returns that you might have gained from owning that position. And since ETFs trade like a stock, you truly just buy it at the share price. So, if it's trading at $87, you buy it at $87. If you're trading at $60, you buy it at $60. And generally, there's no way around it unless you're into one of those programs that offers like fractional shares. That's not something I'm completely educated on, so I'm going to let that go. But a mutual fund, when you make that initial investment, you have like an initial purchase price. So commonly what you'll see for a mutual fund is like $3,000, $5,000, $10,000, so on and so forth. And then once you make that initial investment, you could put as much money into it as you want. So you could put in $5, another $1,000, $100,000 if you really wanted to. So it's a little bit easier, especially in something like a retirement account, to own a mutual fund if you're just going to contribute what you can. So if you can only afford to contribute $5 at a time, that's totally fine, because once you already own that position of the mutual fund, you can contribute whatever you'd like into it. You can reinvest your dividends real simply into that. So that is one of the advantages of having a mutual fund in a retirement account, is just the ability to control how much you're investing or how much you're able to put away into that account. The other thing too, just worth noting about those initial investment costs, I guess we can call them, is some of them offer discounted expense ratios if you put in more money. So let's just say, for example, there's a mutual fund that has a $3,000 initial investment, and they're going to charge you 0.8% for an expense ratio. But if you have $10,000, they're going to charge you 0.2% for an expense ratio. So always look into that as well. If you have the extra money and have the ability to invest in, those larger funds, then certainly take a look at it and see if you can get that lower expense ratio. But also bear in mind, $3,000 is enough, or you wouldn't be maxing out your contributions for a year, but at $10,000 you would max out your contributions for a year for that fund. So just keep that in mind. You never want to have an excess contribution to your retirement account, so sometimes it's better to pay a little more in expense ratios, so that way you don't have an excess contribution to retirement account. So I hope that video made sense for you. It was just a pretty quick overview on the differences and similarities between ETFs. If you have any questions about them, please let me know. I know that it's not exactly set in stone which is going to be the best one for you, but it really depends on your investment style. I would say in a nutshell, this isn't really advice, but kind of the rule of thumb that I follow, mutual funds are for retirement accounts, so I can contribute as much as I want to at that time, and that way I don't have to worry about the tax situation associated with mutual funds. Where ETFs are something I would either take advantage of a non-retirement account, or simply put, if you just don't have $1,000 or $3,000 to get started with investing, see if there is an ETF equivalent of that. That way you could start with owning the same position, and then as you kind of buy more and more of that fund or of that ETF, if you eventually reach how much the fund minimum is for the mutual fund equivalent, you can exchange your ETF into the mutual fund. Might have lost you there, but bear that in mind. And I guess maybe the last thing I'll say about these is if you're transferring between brokerage firms, so if you're going from, Schwab to Fidelity, or Schwab to E-Trade, or E-Trade to Vanguard, one of those, generally ETFs are going to be a lot easier and more cost effective to transfer than a mutual fund. Mutual funds are still a little weird when it comes to transferring them. Not every institution holds every single mutual fund out there. So if you are switching between firms, always have a statement ready to go, so that way you can call the firm that you're transferring to and just make sure everything can transfer over and that you won't have anything lingering behind at the other institution. Again, thank you so much for the time today. You could be anywhere in the world, but you're right here with me, and I really appreciate that. Hope you have a great rest of your day. Everyone, please stay safe out there, wash your hands, and I'll see you next time.